Welcome to What's Up in Real Estate. Each month, I'll be presenting an updated monthly market report. This month, we're going to look at how 2023 is expected to pan out. My name is Wayne Zool, broker associate with RE/MAX First Realty 2 in Cranford, New Jersey. I've been working in the real estate industry and studying the markets for more than 15 years, and in this video, I'll be walking you through several topics, including interest rates. Certainly they define 2022, and we're going to talk about that and what's going on with them. Second, we'll talk about some headlines that are out in the world of real estate. And third, we're going to wrap up talking about what's to come for the market in 2023. Let's jump right in. The first topic that we have is what's happening with mortgage rates. The picture here is really appropriate. It's a roller coaster. You can tell that these folks are on a loop, but what I can't tell is if they're going forward or are they coming back. I can certainly tell that they're upside down, and that's kind of how we feel after what we saw in 2022 with mortgage rates. A couple of quick facts. We've never been in a year where the average 30-year fixed mortgage rate has doubled in a single year, and it's been the fastest rise in mortgage rates since they started tracking them more than 50 years ago. So to say it's an anomaly year in a lot of ways is certainly the truth. But I want to break down where rates are now and a couple of very interesting things that I think tip the hat to where they're going in 2023. Now, no doubt this year has been defined by rising interest rates, but the moral of the story, or the story itself, is all about inflation. And going forward, what's really going to be the determiner of the market is the Fed's ability to control inflation. But let's go on this journey and let's break down where rates are right now and where the experts are pointing that they're going into next year. The first quote here is from Lawrence Yun, the chief economist for the National Association of Realtors. He says, "A return to a normal spread between the government borrowing rate and the home purchase borrowing rate will bring the 30-year mortgage rate down to around 6%. As I'm recording this, the average 30-year fixed is almost 7.5%. We saw the rates fluctuating a bit in December, but what Lawrence is referring to here is the 10-year Treasury. He calls it the government borrowing rate, and then the 30-year fixed, the relationship between the two, and this is the spread that we see. Now it's important to remember that for almost 50 years, the 30-year fixed mortgage rate has moved in unison with the 10-year Treasury yield. So if you want to know where the mortgage rates are heading, watch the 10-year Treasury yield and the spread between them. You see in the middle of the screen here, the average spread has been about 1.7%, or 170 basis points. Literally, if you take the 10-year Treasury and then add 1.7% to it, you would get the 30-year mortgage rate in this range there. Here's a couple of very interesting facts about this year's mortgage rates that we haven't seen before. It's been a market that experts and forecasters have never seen. In a market that's doubled and the fastest move in the last 50 years. But if you look at the 10-year Treasury, this is a look at the 10-year Treasury as of December 1st. This goes all the way back to the end of last year through December 1st. What do we see? Just that rise up. The 10-year Treasury has been rising kind of up and down, but the trend has definitely been up. Now let's talk just a minute about that quote that Lawrence Yun mentioned. He said, and I quote, "A return to a normal spread," end quote. That's the spread between the 10-year Treasury and the 30-year fixed rate, and I want to break that down for you to maybe show you what it means. I'll use this graphic and pose the question, why are mortgage rates not at 5.5%? If we start at this box on the left, let's say we go back to the year 2000 and look all the way to 2021 and look at the average 10-year Treasury, the average spread, 1.7%, you see that the 10-year Treasury, 3.49% in that blue box, 1.79 in the orange box, gives you a mortgage rate of 5.28. That would be the average between 2000 and 2021. Well, where are we today? I mentioned before that the mortgage rate is almost 7.5% on a 30-year fixed. Well, today, as this is being recorded, or December 28th, the 10-year Treasury yield is at 3.84%. The spread is about 3.6%, giving us that 7.5% interest rate. Now today, if the spread were normal, and we were in a range of, let's say, 3.7%, then on this third box we have 1.79%. The spread in the Treasury yield is like what we've had historically. If it is, we would be at about 5.5% in the average 30-year fixed mortgage. Why is the spread so much higher right now than what it's been historically? The quick answer is a nod to a couple of different things. One, market volatility no doubt is driving rates higher. Second, the investors that determine these rates know that everybody that's buying right now will refinance these mortgages, and so they're charging a premium for them. Mortgage rates will come down. It's just a matter of time as we go into the new year and we get inflation under control. Now, I don't think we're out of the woods right now by any stretch of the imagination. But what are experts saying about rates as we go into next year? Let me give you some perspective on that. Ali Wolf says this: the housing market is expected to face continued uncertainty heading into 2023 as consumers, financial markets, and policymakers work through their respective challenges in today's economy. No doubt we're in an uncertain market. There's a lot of volatility and a lot of questions on the economy, on geopolitical events, the war in Ukraine. All of those things are causing uncertainty. As we move into the new year, what we want to see is some of that get eliminated. Inflation gets under control, but there's still more work to get there. If we take Barry Habib's perspective from MBS Highway, because we see a slowdown and we see the inflation comparison start to become more and more favorable, you'll start to see that inflation number move lower, lower, lower. As a result, mortgage rates should move similarly on a downward trajectory, probably giving us around 5% or below 5% within the next 6 months. Now we'll see if Barry is right about that, but no doubt, as the market becomes more certain going into the new year, we should expect interest rates to go down. Now, I don't think we're going to see anything in the 3s or the 4s, probably more like the mid-5s to low 6s. But no doubt, as we see more of that, we should expect to see interest rates get a little bit of relief. I think the amazing thing about that is if you turn on the news or you watch the news, you certainly don't see that represented. Most of the housing market information that they present is all doom and gloom. And here would be my message on that. Don't trust headlines without the proper context. There are so many headlines flying around here and there, saying things, giving you information that does not always best represent the truth. I'll give you an example of this. Diana Olick published this as a tweet. Homeowners have lost $1.5 trillion in equity since May as home prices dropped. Now, this is coming from a Black Knight study, so a factually accurate headline there. But what we want to do is we want to be able to put this into perspective. If somebody sees that, they're going to think, gosh, the housing market sounds like it's about to tank. Well, that drop in equity, put in perspective, it looks just like this. There's been a surge in tappable equity in this country. Tappable equity is considered to be until you get to 80% LTV, or loan-to-value ratio. The last 20% doesn't even count in this scenario. And what do you see? This run-up from 2020 to 2021 and into 2022, and it just gives you perspective, even visually right here. You can see nowhere near where we were back in 2008, or the dip down during that time. So it's always important to take a headline like that and see it in the proper perspective. First American said this: Homeowners have very high levels of tappable home equity today, providing a cushion to withstand potential price declines, but also preventing housing distress from turning into a foreclosure. The result will likely be more of a foreclosure trickle than a tsunami. Thankfully, we're seeing that in a lot of other places. The experts are saying, you know what? The level of equity that homeowners have today is providing them with options if they were to have to sell, limiting the number of people that go into foreclosure. I'm talking about foreclosures in just a minute because I think that this idea of debt is a topic that many of us are wondering about going into the new year with inflation bearing down on everyone. How's that going to turn out? If you look at the headlines, I'll give you an example of a CNBC article. Household debt soars at the fastest pace in 15 years as credit card use surges, the Fed report said. This is from an article in the New York Fed. Again, if you think about household debt, this is talking about credit cards, and then maybe that leads to delinquencies in a mortgage. We'll talk about that in just a second. But if we go back, and again, we put this into perspective, credit card balances are near where they were in 2019. If you think about where we were in 2019, go into 2020 and the pandemic. Now we're starting to come out of that. What do we know happened? It's very explainable. During the pandemic, stimulus money, loans that were given to people and businesses, we know that savings rates jumped up during the pandemic. People weren't using their credit cards. Now that we've worked through that, people are again borrowing and using their cards. Now we want to stay on top of that. We want to continue to monitor this, but it's not exactly accurate when you look to that and think, where are we with credit card debt? Liberty Street Economics, which is the blog of the New York Fed, said this: though delinquency rates are rising, they remain low by historical standards, and suggest consumers are managing their finances through this period of increasing prices. So as inflation is affecting everyone, consumers are managing through that versus being taken down by it. That directly leads to the mortgage conversation, because if you can't pay your bills, you have to use your credit card. Can you pay your rent? Can you pay your mortgage? What we always like to use is the household debt service ratio for mortgages as a percentage of disposable income. This is published by the Fed. If you look at this, where we stand today, 3.9%, considerably low when we go into the 80s and the 90s and the 2000s. And I bring this to you for a couple of reasons. If we're not educated on these things, then the headlines, the conversations, what people say, sway us from one side to the other. Having all the information and being armed with it, I believe, is critical. It is no longer something that's nice to have. It's a must-have in this market, because these conversations are going to continue through the winter, depending on where you're at during the long, cold winter. And I think that there's more that we need to get through in this market. I think interest rates are still going to be volatile, even though we've seen some relief. But are we going to make it? Is the housing market going to crash? There are certainly articles and folks on YouTube and other places that are saying that. I'm here to give you a little bit of perspective right now on that. Let's start with delinquencies, because that's obviously the leading indicator of any foreclosure. MBA Marina Walsh, industry analyst, says, for the second quarter in a row, the mortgage delinquency rate fell to its lowest level since the MBA survey began in 1979. It declined to 3.45%. Foreclosure starts and loan and process foreclosure also dropped in the third quarters to levels further below their historical averages. This is what I'm here to say. This is the reality regarding delinquencies. They're lower than what they've been in a long, long time. You can go check out this article and read that for yourself. Now, I'm not going to say there aren't people that are affected by the slowdown in the economy. There very much will be, but homeowners have options today. They can sell their home, pay a commission, and still put some money in their pocket. and move to the other side of the financial crisis that they're facing. I think that's important. Even if we look at this and think about foreclosures, foreclosures are up this year, but they're still near record lows. As of the third quarter, there have been 88,000 foreclosures in the U.S. this year. To put that number into perspective, in 2019, there were 278,000 foreclosures in the U.S., nowhere near what we were heading into going into the pandemic. This is critically important to know. I always say that headlines do more to terrify than to clarify what's actually going on. And relative to consumer debt, to mortgage debt, to really things that are happening out there in the world, my job is to be a knowledge broker, to be the most knowledgeable professional on these topics for the clients that I serve, so that I can help them make a wise and competent decision. Now, we're going to talk about the 2023 housing market forecast. No doubt there are going to be questions that come up regarding the next market. What's real estate going to hold next year? Well, hopefully this is the answer. I think that as we start to talk about the housing market forecast for 2023, the best place to start is, where have we been in 2022? I truly think that this housing market has been defined by two key things: inflation and rapidly rising mortgage rates. Now, we're starting to see signs of inflation easing, and we know that the Federal Reserve is still making moves to lower inflation, and we're certainly not out of the woods yet. But where that lands is really going to impact what happens with the housing market next year. I think the housing market in 2023 is going to be defined by, can the Fed bring inflation down and keep it there? And will we see stability in the market, especially around mortgage rates? Where I want to begin today is talking about mortgage rates, home sale prices, how all these factors are starting together for 2023, and what the experts are saying. Let's begin with a quote from Jerome Powell, the chair of the Federal Reserve, and I think this really sets the stage for what the Fed was out to do this year. It says, "I'd say if you were a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, where inflation is down low again and mortgage rates are low again." This is exactly what the Fed was saying back in June. We need a bit of a reset. We need to slow the economy. We need to get the housing market back to a place that's a little bit more balanced. Now, all of this is driven by inflation. We've watched the Federal Reserve make moves to try to lower inflation this year. That work is still in progress. And, as I said earlier, we're not out of the woods yet. But it's definitely had an impact on mortgage rates, as well as buyer activity, inventory, and on prices. It's really put the market back into that reset position, and there's much more to come in that space. If that's really what started to define 2022, let's talk about where 2023 is headed and what the experts are saying. I want to begin with mortgage rates, and I think that we can all agree, as I just mentioned, 2022 was defined by rising mortgage rates, and this is a look at the Freddie Mac 30-year fixed going all the way back to January of this year. The big takeaway is that rapid rise. This has never happened before in a calendar year. Mortgage rates more than doubled in 2022, and we've never seen that before. So it's less about the number, it's less about the fact that a little over a month ago, mortgage rates ticked up over 7%. It's really more about that rapid rise that has caused uncertainty, confusion, and people in the market just saying, hey, I'm not ready to jump in. This has had an impact on the balance of the housing market. It's slowed buyer demand and it's slowed the pace of sales. And that's really what we've been looking at in 2022. As we start to think about what's ahead for the next year, mortgage rates are really hard to project. After all, it's all about inflation. We're going to continue to watch inflation, and as inflation is high, mortgage rates tend to be high. But as we're starting to see signs of that potentially turning, we want to know where mortgage rates are going to go, what the experts are saying right now. If you look at Freddie, Fannie, MBA, and NAR, We average those together roughly somewhere between 6 and 6.5% in 2023. So starting out about a point lower than where we are right now. Possibly the rates will start ticking down if inflation starts to come down too. The reality of it is, it's less about the number and more about the market that's looking for stability. It's looking for mortgage rates to level out. Now, whether that's somewhere between 5 or 6.5%, I don't know. But the goal is for mortgage rates to stabilize. We certainly aren't talking about the record lows we saw over the past 2 years, but we shouldn't be talking about rapid acceleration either. As inflation starts to turn, that's what we're going to be looking for to see what happens with mortgage rates. This is realistically what experts are saying right now. And I think this quote from Greg McBride at Bankrate really says it all. It says, mortgage rates could pull back meaningfully next year if inflation pressures ease. It's all about inflation. If the Federal Reserve continues to hike federal fund rates up as aggressively as they have been, that's going to have a different impact on mortgage rates. The reality of it is they may go up before they come back down. It's not really a matter of if mortgage rates will come back down, it's really more of when. That's what we're going to be watching in response to inflation. Now, as we've seen inflation rise during 2022, and we've seen mortgage rates tick up, that's impacted home sales. Let's talk about what home sales look like for 2022, and then the projections for 2023. Total home sales for 2022. You can see that on the green bar right there. This is a combination of existing homes and new construction projected to end the year at around 5.8 million home sales. Now, coming off of last year, that feels like a major slowdown. In 2021, we sold roughly 6.9 million homes. That was significantly higher than where we are right now. And if you look back in time, and that's what you can see on this graph, this goes all the way back to 1999. We haven't seen 5.8 million home sales in about 10 years or so. So this is going to feel like a slowdown. As far as real estate was concerned, 2022 felt like you were flying down the highway at 90 miles an hour. Things were moving really fast. You came around the bend and saw all those flashing lights and you hit the brakes real hard. And while you were still moving forward, it felt a lot slower. So coming off that high of 2020 and 2021, this year feels a little bit slower. And if this feels slow, let me share with you what 2023 is projected to look like. 5.1 million home sales. Now that's going to feel even slower. However, I want to stop for a second and talk about this projection for next year that the experts are saying. Now 5.1 million home sales, that's less than we had in 2022, definitely less than in 2021. But here's the thing, experts tend to reproject throughout the year. And right now they're making projections for 2023. And those are based on a lot of different things. Right now we're in a place where inflation is high. Mortgage rates are high. We're still seeing buyer demand, but it's not as high as it was. We have more inventory on the market, but we're not seeing a ton of new listings. We're also seeing new construction slowing a bit. So projections for next year are clearly lower. Now I think as we start to see that nod towards the Fed getting inflation under control, that mortgage rates should potentially be coming down in that moment in time. As we start to see that, I anticipate that this number of 5.1 million home sales will start to tick up throughout 2023. It's really not a matter of if, more about when we start to see that activity really kick back in. If we look ahead at how some of the experts are breaking down total home sales for next year in millions, anywhere from about 4.5 to 5.5 million homes. Let's put that into context and average them all together and look at this and say, the truth is probably somewhere in the middle. Maybe not the high end, maybe not the low end, but the average right now is showing about 5.1, and we're going to continue to watch that number. So the question becomes, what's going to tick back up? What's going to cause more transactions? What's going to reinvigorate that number in 2023? I think this quote from Lawrence Yun really says this well. The upcoming months should see a return of buyers, as mortgage rates appear to have already peaked and have been coming down since mid-November. So as we start to see inflation hopefully come under control, mortgage rates respond. We're going to see more buyer activity. Buyers are looking for stability and predictability in the market, and as that starts to unfold, well, we've got a bumpy road ahead. Hear me out on that. As that starts to unfold, we will see more buyers come back into the market, and that should start to increase the pace of sales as well. And it says that mortgage rates have already potentially peaked. We hope that's right. We are going to continue to watch that because that's a really big part of what we've seen happening in the market in 2022. Now, as we start to talk about 2023, home prices are the big thing on everyone's mind as well. And I want to walk through what the experts are saying about home price forecasts for 2023. I think this graph really breaks down several of those leading experts, and really the latest forecasts are showing some experts are saying home prices are going to appreciate a little bit in 2023, while other experts are saying they expect home prices to come down a little bit in the new year. This is the year-over-year appreciation for 2023. Now again, context is key. We bring all of these together, we average them all out, and if you look across the board, we see roughly neutral or flat home price appreciation in 2023. That's what happens when we pull all these together and take a look at the big picture. The clarity and the truth is probably somewhere in the middle. That's where the average really comes from. And we're coming off a point in time earlier in 2022 where we had 20% year-over-year home price appreciation. We're certainly not looking at that going forward, but we're also not looking at massive declines. Nobody is calling for 10 or 20% home price depreciation in 2023. Why is that? Well, it's all about supply and demand. The more buyers we have in the market, the more home prices will rise. That balance of more buyers than homes available, that tends to put upward pressure on home prices. Right now, we're sitting at about a 10 to 11% year-over-year home price appreciation. I've also been looking at month-over-month home prices, and we're seeing a little bit of a month-over-month decline. What we're seeing right now is that decline is getting a little bit smaller. So as we look into 2023, we're really looking at flat or neutral home price appreciation. It's going to be different market by market. More on that shortly. I think this quote from Mark Fleming really talks about the demand that we're looking for, and it says, "The housing market, once adjusted to the new normal of higher mortgage rates, will benefit from continued strong demographic-driven demand relative to an overall long-run shortage of supply." We still have more buyers than sellers in most markets. We still have this massive demand from millennials aging into the home buying age, and all of those factors are going to continue to put upward pressure on home prices. Again, this is really a nod toward looking for that stability. Once the housing market is adjusted to the new normal, adjusted to mortgage rates, potentially settling back into a more stable range, we're going to see more buyers come back into the market. And that's really going to tip what we're feeling right now about 2023. I want to end on this quote from Doug Duncan from Fannie Mae, because I think it really says it well. He says, "From our perspective, the good news is that demographics remain favorable for housing." So I believe that the demand for people to buy homes will be up in 2023. The sector appears well positioned to help lead the economy out of what we expect will be a brief recession. I started at the beginning talking about how all of this is about inflation. The more we start to hear about inflation coming under control, inflation coming down, that sparks the conversation about a potential recession. As we talk about a recession, we never want to wish a recession on anyone. But it's more and more likely that we will see a brief recession when inflation starts to come down. So the ever important question becomes, what does it mean for the housing market if we do see a brief recession? History tells us mortgage rates come down. What happens as inflation lowers and mortgage rates come down? We will see more buyers come back into the market. Buyers will have more options to choose from. They want stability. As we start to see all that unfold, we're going to see 2023 respond in that way. So what's the overall takeaway? Again, it's all about inflation. The market wants stability. We're looking for mortgage rates to stabilize and become more predictable. We're watching the economic drivers around us, and we're still seeing demographic demand that's going to drive the housing market forward. As I wrap up, I want to remind you that I offer free, no-obligation guides available as PDF downloads for buyers, sellers, and first-time buyers. The buyer and seller guides are updated quarterly so that you always have up-to-date information. I would be happy to give you a detailed analysis of your local market as long as you're in New Jersey. If you're out of state, I can connect you with an agent that can help you. If you would like to get a free market analysis on your home, just reach out to me. You can reach me by email at wayne.zool@gmail.com or on my cell phone at 908-917-4189. Likely I'll have several questions about your home, and it will take me a day or so to get my analysis to you. Tune in again in mid-January as I post the updates from the December data. Thank you for watching, and feel free to contact me with any questions.